Hello everyone and welcome back to Explain the Charts. Today is October 2nd, 2025, and we are diving into a comprehensive analysis of the S&P 500 ETF, ticker symbol SPY. The market is at a fascinating crossroads, caught between significant macroeconomic headwinds and a strong underlying bullish trend. First, let's break down the news that is driving the current sentiment. The biggest headline is the U.S. government shutdown, which began after lawmakers failed to reach an agreement. This has created immediate uncertainty, with around 750,000 government employees suspended from work, potentially slowing down critical economic functions. Historically, shutdowns can create short-term bearish pressure as investors weigh the economic impact. Adding fuel to the fire, yesterday's ADP private payrolls report came as a shock, showing an unexpected loss of 32,000 jobs in September, completely missing the forecast for a 45,000 job gain. This week's labor market data, however, is having a paradoxical effect on market expectations. Traders are now pricing in a staggering 99% probability of a Federal Reserve interest rate cut later this month, viewing this negative economic signal as a green light for looser monetary policy. This bad news is good news dynamic is creating a major tug-of-war in the market, especially since futures for the S&P and Nasdaq are pointing higher this morning on that rate cut optimism, even as the shutdown looms. Now, let's see how this news correlates with the price action on our daily chart. We can see a powerful uptrend that has been in place for most of the year, taking SPY to new all-time highs just yesterday. The price reached a peak of $669.37 before reversing sharply. This reversal candle on October 1st is significant. It shows that sellers stepped in with force right at the peak, coinciding with the official start of the government shutdown. This creates a major resistance level right at that $669 to $670 zone. A decisive break and close above this level would be extremely bullish, signaling that the market has absorbed the bad news and is ready to continue its ascent. On the downside, we have our first key support level in the $661 to $663 range, which represents the consolidation area from late September. A break below this level would be the first sign of real weakness and could open the door for a deeper correction. The next major support area to watch would be around the $650 mark, which was a previous resistance level in early September. Looking further back, we can see a major period of volatility in early April, where SPY experienced a dramatic sell-off to a low around $481 before beginning its strong recovery. Let's switch to the 1-hour chart to get a clearer picture of this recent price action. Here we can see the consolidation throughout the end of September, where SPY traded in a tight range, building up energy. The breakout on September 30th was powerful, leading to that final push to the all-time high on October 1st. However, the reversal that followed was just as aggressive, erasing the gains of the previous day and a half in just a few hours. This price action indicates a classic bull trap or a rejection at a key resistance, fueled by the fundamental news of the shutdown. The price is now sitting precariously above that late September support range. To get an even closer look at yesterday's battle, let's zoom into the 15-minute chart for October 1st. We can see the market gapped up at the open and made a quick push to the high of $669.37 within the first hour of trading. But immediately after hitting that peak, the sellers took complete control. Notice the high volume on these red selling candles, confirming the strength of the reversal. The price broke down through multiple intraday support levels throughout the day, closing very weak near the session lows. This intraday action painted a very bearish picture, suggesting that downside momentum was accelerating into the close. So, let's go back to the daily chart and synthesize all of this information into actionable scenarios. What are the key levels and potential outcomes we should be watching for? First, let's recap the critical price levels. Immediate resistance is the all-time high zone of $669 to $670. Our primary support level is the range between $661 and $663. A more significant, secondary support lies at the psychological and technical level of $650. Now for the bullish case, the broader trend remains upward. If the market continues to focus on the high probability of a Fed rate cut, and if buyers can push the price back above yesterday's high of $670, this recent drop will be confirmed as just a minor pullback. This would open the door for a move towards $680 and beyond. I would place the likelihood of this scenario at around 60%, but it is heavily dependent on seeing a strong buying response in the next couple of sessions. For the bearish case, the reversal candle at the all-time high is a technically powerful bearish signal. If the economic uncertainty from the shutdown and poor jobs data begins to outweigh the optimism for rate cuts, sellers could take control. A daily close below the $661 support level would be a major warning sign, increasing the probability of a drop to test the $650 support area. I'd give this scenario about a 40% chance right now, but that probability would increase significantly if we break that $661 support. In summary, the market is at a pivotal inflection point. Watch to see if the rate cut narrative can overcome the real-world economic concerns. The key things to look for are a decisive break of resistance at $670 for a bullish confirmation, or a break of support at $661 for a bearish signal. As always, thank you for tuning in to Explain the Charts. Before we go, a quick disclaimer: this video is for educational and informational purposes only and should not be considered financial advice. Trading involves risk, and you should always conduct your own research and consult with a certified financial advisor before making any investment decisions. We'll see you in the next video.